Okay, good evening. I'm going to discuss the contents of the PowerPoint. This time we have chapter 16, error correction. Okay, so I hope you will continue with our YouTube discussions. So at least you'll be able to learn whatever are found in the different chapters for error correction. Now, for error correction, we have the following objectives. Okay. Uh, to know the definition of prior period errors, or to be familiar with the definition of prior period errors, to understand the accounting treatment of prior period errors, to be able to distinguish counterbalancing errors and non-counterbalancing errors, and to be able to prepare the necessary correcting entries for prior period errors. Now, for first, we have to define prior period errors. They are omissions and misstatements in the entity's financial statements for one or more periods arising from a failure to use or misuse of reliable information that was available when financial statements for these periods were authorized for issue and could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements. Prior period errors include the effects of mathematical mistakes, mistakes in applying accounting policies, oversights, or misinterpretation of facts, and fraud. Okay, so we have now the treatment of prior period errors. An entity shall correct material prior period errors retrospectively in the first set of financial statements authorized for issue after their discovery. A prior period error shall be corrected by retrospective restatement, meaning if comparative statements are presented, the prior year statements are restated to correct the error. The correction of a prior period error is an adjustment of the beginning balance of retained earnings of the earliest period presented. Statement of financial position errors. This affect the statement of financial position or real accounts only, meaning the improper classification of an asset, liability, and capital account. In such a case, an entry is simply made to reclassify the account balances. For example, if preference share capital is erroneously credited instead of ordinary share capital, the reclassifying entry is debit preference share capital and credit ordinary share capital. Then we have the income statement errors. Income statement errors affect the income statement or nominal accounts only, meaning the improper classification of revenue and expense accounts. These errors have no effect on the statement of financial position and on net income. Thus, reclassifying entry is necessary only if the error is discovered in the same year it is committed. Otherwise, if the error is discovered in a subsequent year, no reclassifying entry is necessary because the nominal accounts for the current year are correctly stated. Then we have the combined statement of financial position and income statement errors. These affect both the statement of financial position and income statement because they result in a misstatement of net income. For example, if accrued salaries payable is overlooked, the effects are salaries expenses are understated. It's an income statement error. The liability is understated, meaning a financial position statement error. Net income is overstated. Again, it's an income statement error. And retained earnings overstated. It's a statement of financial position error. Combined statement of financial position and income statement errors are classified as counterbalancing errors and non-counterbalancing errors. Counterbalancing errors are errors which, if not detected, are automatically counterbalanced or corrected in the next accounting period. In other words, these errors will be offset or corrected over two periods. Of these errors corrected themselves over two periods. Effects of counterbalancing errors. Income statements for two successive periods are incorrect. The statement of financial position at the end of the first period is correct. However, at the end of the second period is correct because as we have to at least find out what happens in the second year. Now the error is already eliminated and you have the counterbalanced error. Counterbalancing errors normally include the misstatement of the following: inventory, including purchases and sales, prepaid expense, accrued expense, deferred income, and accrued income. Next are non-counterbalancing errors. Are errors which, if not detected, are not automatically counterbalanced or corrected in the next accounting period. In other words, if the net income of one year is understated or overstated, the net income of subsequent year is not affected. Effects of non-counterbalancing errors. The income statement of the period in which the error is committed is incorrect, but the succeeding income statement is not affected. Statement of financial position of the year of error and succeeding statement of financial position are incorrect until the error is corrected. The best example of a non-counterbalancing error is the misstatement of depreciation. Okay? So we have now your prior period errors. Next, we go to the problems of chapter 16. With regards to this problems, we have up to problem 16 20 for the theory part. Now let's begin with the problems in 16-1 and 16-2. These problems are straight problems, and then we will follow up with the multiple choice problems. So 16-1, 16-2 for our straight problems. Okay, now let's begin with 16 dash 1. 16 dash 1. Okay, now for 16 dash 1, required prepare a worksheet showing corrected net income for 2019 and 2020. And second, we have to prepare adjusting entries on December 31, 2020. And with two assumptions, the books are still open. And second, assuming that the books are closed. Now, when we talk about books are still open, in other words, we have not yet closed the nominal accounts to expense and revenue summary, or revenue and expense summary, or profit and loss summary. So meaning we have not yet closed the accounts. Okay. So in chapter 16, first we have this worksheet, and then second we have the adjusting entries on December 31, when with two assumptions, the books are still open and closed. Next, we have in requirement number 1, we have the worksheet. So we have for 2019 and 2020, the net income figures given, and then an examination of the accounting records for the year ended December 31, 2020 revealed that several errors were made and the following were discovered. Salary accrued at year end was consistently omitted. So we have 2019 and 2020. As we have listened to the PowerPoint presentation, then we consider counterbalancing errors for our accruals. So for this, here we have the footings and extensions showed that the inventory on December 31, 2019. Okay. We have interest receivable of 20,000 was not recorded on December 31, 2020. In January 1, 2020, an equipment costing 400,000 was sold for 220,000. At the date of sale, the equipment had accumulated depreciation of 240,000. The cash received was recorded as miscellaneous income in 2020. In addition, depreciation was recorded for the equipment for 2020 at the rate of 10%. So we now have the requirement number 1 for the worksheet. So we copy net income, extend to the 2 years, then salary accrued, committed. In 2019, we are having 100,000. So we deduct from 2019 and add it to 2020. Now, actually, it was salary accrued. It was not recorded. So, in other words, if in 2019 it was not recorded, salaries total was understated. If salary total was understated, in other words, the net income was overstated. So to correct, we have to deduct from the 2019 net income and add it to the 2020 net income, because if the salary accrued was omitted in 2019, it was just recorded in 2020 upon payment of the accrual. So in other words, the 2020 salaries included 100,000. And so the expenses, uh, specifically salaries, total was overstated. Therefore, net income was understated. So we have to add back. Then salary in 2020, again deduct 140,000 and add it to 2021 net income. The inventory on December 31, 2019 was overstated. So the ending inventory was overstated. In other words, cost of goods sold was understated. If the cost of goods sold was understated, our net income was overstated. So we have to deduct. Now, likewise, in 2020, the inventory on December 31, 2019 is the beginning inventory in 2020. And the beginning inventory was overstated meaning cost of goods sold in 2020 was overstated. So net income was understated. So we have to add back. Next, prepaid insurance unrecorded on December 31, 2020, meaning all amounts for insurance payments, all amounts were charged to insurance expense. So if insurance expense was overstated, net income was understated. So we have to add back 120,000. Interest receivable and recorded on December 31, 2020. So meaning it was not recorded. Interest income was not recorded. So we have to add back in 2020. Other income overstated for 2020, so overstated. That's why we have to deduct back 160,000. And depreciation was overstated in 2020. Okay. Now, overstated meaning total expenses was overstated due to the overstatement of depreciation. And so in 2020, net income was understated. So we have to add back. Corrected net income after adding or deducting the adjusting entries or the adjustments. We have for 2019, 1,460,000 and 2020, 2,170,000. Now we go to the adjusting entries on December 31, 2020, when we assume now that the books are still open. So number 1, we debit to retained earnings for 100,000. That's why we are deducting from net income. And credit to salaries. So credit to salaries, meaning we have this amount was recorded as salaries expense in 2020. We have to credit back because actually they were salaries expenses in 2019. So credit back salaries or salaries expense. Then we record salaries 140,000 and credit accrued salaries payable. Then number 2, we debit to retained earnings and credit to inventory on January 1, 2020 because of the overstatement, and debit to retained earnings. As we can see, the amount of the retained earnings adjustment is 190,000, meaning we have to debit retained earnings. Then number 3, prepaid insurance is debited for 120,000 and credit insurance or insurance expense. Then in number 4, we have now to uh, recognize the amount of, in number 4, we have to recognize the adjustment for accrued interest receivable for 20,000 and credit to interest income. Now we are adding 20,000 to the 2020 with the assumption that books are still open, so we can use the nominal accounts. Then in number 5, we debit to miscellaneous income for 220,000, debit accumulated depreciation 240,000, credit equipment, and credit gain on sale of equipment. Now stated January 1, 2020, an equipment costing 400,000 was sold for 220,000, and at that date the equipment had accumulated depreciation of 240,000. However, the cash received was recorded as miscellaneous income. So meaning the entry made by the company was to debit cash and to credit miscellaneous income for the amount of 220,000. Now, the credit to miscellaneous income was wrong. So, we have to debit back miscellaneous income. So, to close the account because there is no miscellaneous income at all. Then we debit to accumulated depreciation for 240,000. We have to close the account because the equipment was already sold. Then we credit equipment at cost of 400,000. The total debits 460,000 and the credit equipment of 400,000. In other words, there's a gain of 60,000. Then likewise, we debit to accumulated depreciation by 40,000 and credit depreciation by 40,000. In addition, the depreciation was recorded on the equipment for 2020 at the rate of 10%. So 10% was computed based on the original cost of 400,000. So in other words, the company made the customary or the ordinary entry in recording depreciation, debiting depreciation, crediting accumulated depreciation, but there is no need for such entry because the equipment was already sold. You can no longer charge depreciation expense for the fixed asset that was already sold. So what you will be doing in your adjusting entry, you reverse the entry. That's why you debit accumulated depreciation and credit depreciation. Now, in the second assumption, the books are already closed. So, when the books are closed, meaning the nominal accounts are already closed. So, with this, we debit to retained earnings. We debit to retained. Okay, so let's continue after the brownout. We are still recording after the brownout. So we now have the books, assuming now that the books are closed. So we have the adjusting entries, debiting to retained earnings for the amount of 140,000 and credit to accrued salaries payable. In other words, we now assume that the books are already closed. So there is no need for the nominal accounts. So there's no adjustment for number 2. And number 3, we now debit to prepaid insurance and credit to retained earnings. Number 4, debit to accrued interest receivable and credit to retained earnings. Now you can relate this to the adjusting entries in assumption number 1. Now the difference is in assumption number 1, the books are still open. In other words, you still have the nominal accounts. Okay, so we now go to problem number 2. Here, prepare a worksheet for correction of net income for 2019 and 2020 and prepare adjusting entries on December 31, 2020. So we have now the First requirement is for us to prepare a worksheet. So again, we have net income as given above, 3 million and 4 million. First, in an audit for the current year, the following errors are discovered. December 31 inventory understated, on December 31, 2019, understated, but on December 31, 2020, it was overstated. So we now correct the December 31, 2019 inventory is understated by the amount of 20,000. Now, meaning the ending inventory is understated. For 2019, we are going to add to net income. That's the ending inventory. And for 2020, we are going to deduct. However, December 31, 2020, the inventory is overstated by 18,000. Since it was overstated by December 31, 2020, meaning we are going to deduct the amount of 18,000. Depreciation for 2019 is understated. So, meaning the net income was overstated. So, we have to deduct. Prepaid insurance unrecorded December 31, 2019. We have to add back 10,000 because if the prepaid insurance was unrecorded, meaning all payments for insurance were debited to insurance expense. So insurance expense was overstated. That's why net income was understated. You have to add back. And on December 31, now with regards to prepaid insurance, insurance premium for a 3-year period was charged to expense on January 1, 2019. No prepayment was recorded. Supposed to be on December 31, 2019, there is a prepayment of 10,000. 15,000 divided by 3, that's 5,000 a year. But since the full amount was recorded to insurance expense on January 1, 2019, in other words, in 2019, the amount recorded as insurance expense was 15,000, whereas the correct amount is only 5,000. So the 10,000 should be added back to net income because expenses for insurance in 2019 was overstated. Now that's by 10,000. Whereas in 2020, insurance expense was no longer recorded so that the net income was overstated. So you have to deduct back. Then we have a fully depreciated machinery was sold on December 31, 2020, but the sale was not recorded until 2021. The cost of the machinery is 200,000 and the proceeds from sale amount to 32,000. Now, if you are going to prepare an entry for this, the entry is to debit cash for 32,000, then debit to accumulated depreciation by 200,000, the fact that the machinery was fully depreciated, meaning the accumulated depreciation is equal to the cost. So, debit. So the correct entry is debit to cash 32,000, debit to accumulated depreciation 200,000, and credit to machinery 200,000, and credit to gain on sale. Now gain on sale was not recorded because uh, the entry was only made to here. The sale was not recorded until 2021. In other words, the entry was recorded only in 2021. So in the 2020 net income, you have to add back 32,000. We arrived at the corrected net income for 2019 and 2020. Again, prepare adjusting entries on December 31, 2020. Now we have this assumption that the books are still open. The inventory on January 1, 2020 in the amount of 20,000 and credit back to retained earnings. The December 31, 2019 inventory was understated, so we have to add back 20,000 by debiting inventory January 1 and credit to retained earnings for the amount of 20,000. Then we now debit to income summary for 2020. It was only in 2019 that we already have the books closed, so we credit back to retained earnings. Whereas in number 2, we debit to income summary by 18,000 and credit to inventory because the inventory was overstated by 18,000. Next, we have the number 3 entry, so debit retained earnings and credit to accumulated depreciation in the amount of 4,000. Now, the understatement in inventory for 2019. Now, that will continue up to 2020. Then number 4, we debit to prepaid insurance, debit to insurance and credit to retained earnings. And finally, debit to cash, debit to accumulated depreciation, debit credit to machinery, and credit to gain on sale. That was in 2020. Then we go to 16-3. Again, we have the net income for 1919 and 2020. Then next, a collection of 100,000 from a customer was received on December 29, 2020, but not recorded until January 4, 2021. So, no entry was made in 2020. Collection should be recorded in 2020 and not in 2021. We have the amount of uh, 100,000. Now, actually, the entry was supposed to be a debit to cash and to credit accounts receivable. Since we are given the beginning balances as net income, the entry has no effect on our net income. So meaning the effect will be on our accounts receivable in the statement of financial position. Suppliers invoice on account of 160,000 for inventory received in December 2020 was not recorded until January 2021. So this is equivalent to an unrecorded purchase. Supposed to be your entry is to debit purchases and to credit accounts payable. But the entry was made only in January 2021 in the amount of 160,000. Inventories on December 31, 2020, 19 and 20 were correctly stated. And by the way, our unrecorded purchase in 2020, we have to deduct this from net income of 2020 as purchases is added to inventory beginning in determining cost of sales. So meaning our cost of sales is understated, leading to overstated net income. That's why we have to deduct back. Depreciation for 2019 was understated by 90,000. Now this error is non-counterbalancing. Next, in September 2020, a 20,000 invoice for office supplies was charged to purchases. So the entry made by the company was debit purchases and to credit cash. The correct entry is to debit office supplies and credit cash. So the correcting entry is debit office supplies and credit to purchases. That's why we have now the amount of 20,000 office supplies charged to purchases in 2020 in the amount of 20,000. There's no effect on net income. Unrecorded office supplies charged to purchases in 2020. Then we have uh, office supplies are expense when incurred. So the amount of office supplies supposed to be expense when incurred. Sales on account of 300,000 December 2020 was recorded in 2021. That's why you have your unrecorded sales in the amount of 300,000, and that will be added back to your net income. So we have only two adjusting entries on December 31, 2020. One is to debit cash, credit accounts payable. The other one is to debit purchases and to credit accounts payable. Next, we have 16 does we have more entries here for numbers 3. Debit retained earnings, credit accumulated depreciation. For the understatement of depreciation, actually we already debit retained earnings. Depreciation is was understated by 2019, so prior year. Then we debit office supplies and credit back to purchases. However, here we have normally deduct purchases for what was debited. And finally, debit accounts receivable and credit to sales. Next, 16-4. Again, we have net income of given for 16-4. Determine the correct net income for 2020 before adjustments of 1,550,000. Upon inspection of the records, the following facts were discovered for the year ended December 31, 2020. A fire insurance premium of 40,000 was paid and charged as insurance expense. So the entry was to debit insurance expense and credit to cash. Okay? So the correcting entry, you have to debit an adjusting entry on December 31, 2020, supposed to debit prepaid insurance by 10,000 and credit to insurance expense. Now, we have fire insurance premium of 40,000 was paid, and that the fire insurance policy covers 1 year from April 1, 2020. So meaning April 1 up to December 31 is 9 months. So the prepaid portion is 3 months. So meaning that's 3 over 12 multiplied by 40,000. The prepaid portion is only 10,000. That should be added back to net income. Inventory in January 1, 2020 was understated by 80,000. On December 31, 2020 was understated by 120,000. So your entry for inventory in January 1, 2020, 80,000 and credit to retained earnings for 80,000. Now, since inventory understatement was at the beginning of January or reflecting the 2019 records, but the ending inventory was as well understated. So we debit inventory and credit to income summary. Taxes of 60,000 for the fourth quarter were paid in January 2021 is charged as expense. So the entry is to debit taxes, credit accrued taxes payable. So we now record accrued taxes payable as a deduction from net income because the omission of taxes overstated net income. So we have to deduct back. The amount of 100,000 was credited, no, December 5, 2020, a cash advance of 100,000 by a customer was received for goods to be delivered in January 2021. So the entry now is originally that was debited to cash and credited to sales as stated. The gross profit on sales is 40,000. But actually, there is no sales consummated in 2020 because the goods will be delivered in January 2021. So now we debit to sales and credit advances from customers in the amount of 100,000. So we have now your corrected net income for 1,440,000. Now let's go to the multiple choice problems and theory. We have up to 16-20. Now let's begin with 16-5. So 16-5. What is corrected income before tax? The company failed to recognize accruals and prepayments during the first year of operations. The income before tax is 5 million. The accruals and prepayments at the end of the year are prepaid insurance 200,000. Now being a prepayment meaning the amount of insurance paid, all amounts were debited to insurance expense because of the non-recording of the prepayment. So if the insurance expense was overstated, net income was understated. That's why we have to add back 200,000. Accrued wages 250,000. So the accrued wages supposed to be debit to wages. Okay, debit to wages or wages expense and credit accrued wages payable. Now, but if the company failed to record the accrued wages, meaning wages expense was not recorded. So we have to record wages expense and to credit accrued wages payable. So meaning accrued wages not recorded, we have to debit or deduct from net income. Then we have the rent revenue collected in advance. The entry of the company was to debit cash and to credit rent revenue or rent income by 300,000. However, this was a collection in advance. It's not yet rent income. So we have to deduct back rent income. Next, we have the interest receivable by 100,000. It's to be recognized by debiting interest receivable and credit to interest income. So we have to add back to net income. The answer of 4,750,000, the corrected income before tax. 16.6, Victoria Company revealed the following errors in the financial statements. We have the ending inventory and the depreciation. At what amount should retained earnings be retroactively adjusted in January 1, 2021? So the question is in connection with retained earnings. So retained earnings as here, what's the amount of retained earnings be retroactively adjusted on January 1, 2021. So we have now the 2019 ending inventory was understated. This became the beginning inventory of 2020. And then in 2020, the ending inventory is overstated by 300,000. A depreciation in 2019 was understated and overstated in 2020. So we now go to retained earnings, net correction. So for the 2019 inventory understated, we have to add back retained earnings by 60,000 since the 2019 ending inventory was understated by 60,000. So what happens in 2019? Since the ending inventory was understated, so the cost of goods sold was uh, overstated, or the ending inventory is understated. Cost of goods sold was overstated, so that the net income was understated, and so the amount close to retained earnings was understated. The 2019 inventory end becomes the 2020 inventory beginning. So if it was understated, the amount of cost of goods sold was overstated. And so your net income here. So if you say inventory beginning of 2020 understated, then you add it to your purchases. Total goods available for sale is understated. You deduct the ending inventory, so meaning your cost of goods sold is supposed to be understated. So net income was overstated. That's why you have to deduct 60,000. Now, this is an example of a counterbalancing error that even if you do not correct, the effect of this is on the third year, it will counterbalance. In 2019, you have an addition. In 2020, a deduction, meaning zero effect on your retained earnings on January 1, 2021. Then in 2020, the inventory is overstated, so we have to deduct overstatement. In 2020, retained earnings will be understated. So the net correction is 75,000. That's problem number 7. Net correction is 75,000 overstated, so we have to deduct. Then we have 16-8. Um, if none of the errors were detected or corrected, by what amount will 2020 net income be overstated or understated? So in other words, if the errors were not detected or corrected, what will happen to the net income of 2020? But take note that these two items stated, the ending inventory and the rent expense. Now, even if you did not record them, these problems or these items, even if not detected or corrected, they will just counterbalance. So, in the ending inventory of 2019 is overstated. Okay, so the ending inventory in 2019, the ending inventory, you got an overstatement. In 2020, it's an understatement. So, for 16-8, the ending inventory of 2019, we have to deduct back in 2019, 150,000. Net income, the trend of the ending inventory is to reduce net income. So that will also be for the 2020 inventory overstatement, no? The inventory or the ending inventory in 2020, we have the amount of 200,000 understatement. 200,000, so we add it to the 2020 net income. Then the rent expense in 2019, it was understated. So we have to deduct back the 2019 inventory, or rent expense. In 2020, we have the amount of 100,000. This was an overstatement of your rent expense. So meaning to say, the net income was understated. So we have to add back. 16-8, the answer is 450,000 understated for 2020. Next, number 9. We have three questions in number 9. Number 1, what's the effect of the errors in the 2019 net income? Okay, so in the 2019 net income, what is the effect of the errors? Second, on the 2020 net income. And the third is on retained earnings. So we have now the 2019 ending inventory as given is understated by 200,000. In 2019, it was understated. So what happens? We have to add back because the ending inventory was understated. In 2019, this becomes the beginning inventory of 2020. Again, we have to correct by deducting the amount of 200,000. Next, we have depreciation 50,000 under, and an insurance premium of 150,000 was prepaid in 2019 to cover 2019, 20, and 21. The entire amount was charged to expense in 2019. So we have now question 1. The question is, what's the effect of the error in 2019 net income? After we have forwarded adjustments, a depreciation of 2019 understated, insurance premium, one is added and deducted for the amount of the premium. Insurance premium of 150,000 was prepaid in 2019 to cover 2019-20 and 5,000 in uh, 21 2021. The entire amount was charged to expense in 2019. So, wali pagbayad yang entry yan, nag-debit siya insurance expense by 150,000 and credit to cash. When the correct entry is to debit rent expense only for 50,000, and then you have to debit prepaid insurance by 100,000 and credit to cash. In 2020, the prepaid insurance of 100,000, only 50,000 is the prepaid portion. So we have now the next insurance premium already extended. The 2019, uh, no, we have depreciation. 2019 depreciation was understated here. The fully depreciated machinery was sold for 250,000 cash, but the sale was not recorded until 2021. So the entry is supposed to be debit to cash, then we debit to accumulated depreciation and credit to machinery. So if you have to credit machinery for 250,000, and you have to debit accumulated depreciation. So, but the effect of this will be a gain on sale of machinery for 250,000. So actually there is no more depreciation. You debit to cash, debit accumulated depreciation, credit machinery, and credit gain on sale. Now there is no more depreciation because the asset was already fully depreciated and it was sold. So the entry was to debit cash, debit accumulated depreciation, and credit to machinery fully depreciated. But anyway, you can make assumptions as with regards to the solution. Net correction of 250 for 2019 and 2020 for 300,000. Net income of 2019 is 250,000. Then net income 2020 over by 300,000. So the retained earnings here is 50,000. That's for 16-9. The answers are number 1, letter A, number 2, B, and number 3, letter C. Then we go to 16-10. Again, 16-10. We have this analysis at the bottom. 16-10. Net income for 2019, net income for 2020, retained earnings for December 31, 2020, and for working capital on December 31, 2021. So we now begin with the determination of net income for 2019. We have the amounts are already after adjustments. So in 16-10, here we have your understatement. 2019 inventory is understated for 160,000. So we have to add back and deduct from 2020. Next, we have the inventory overstated at year end. So we have reflected the adjustments for the ending inventory, which are both overstated. Next, we have the depreciation understated by the amount of 60,000. Okay. Then we have prepaid insurance understated by 100,000. Understated in 2020, overstated in 2019. And the last, you have a prepaid insurance of 100,000. So the effects of this will be posted. And finally, we have gain on sale of machinery. A fully depreciated machinery was sold for 110,000, but the cash was not recorded until 2021. So we have now the machinery account actually was sold for 110,000. So you only need to debit cash and credit no appropriate account, no. However, what was credited was machinery. So nag-debit ka lang cash and credit to machinery. You have no uh, adjustments that will be in connection with the 21 entry, but you have to record the 2020 correcting entries. So we have gain on sale, we add 2020, and the effect of this to working capital will also be an addition. Next, we go to 16-11. 16-11, what is the adjusted net income for 2020? We have the corrected net income after reflecting the following omissions. So we have the entity failed to record, accrue sales commissions at the end of each year. So in 16-11, the unrecorded commissions of 2018 and 2019. So we have 220,000 and 140,000. Unrecorded meaning expenses were understated. No, we have sales commissions. Supposed to be sales commissions should be recognized by the company at the end of the 2 years. So we have 220,000 negative for 2018 because the expenses were understated, net income overstated. So we have to deduct back the amount of 140,000. In each case, the sales commissions were paid in expense in January of the following year. Errors in ending inventories for the last 3 years were discovered to the following: 2018 We have 400,000 understated, 2019 540,000 understated, and 2020 150,000 understated. The adjusted net income for 2020. So we have now the amount of 3,830,000. That's for 2020. Next question. The retained earnings balance on December 31, 2020. So we now get the amount of net corrections for 2018 and 19, net correction to income of prior year. Then we have retained earnings, January 1, 2020, reflect the effect of prior period errors. Okay, and we have now the net correction to income of 2019 and 20. Question number 2, compute for retained earnings on December 31, 2020. And so you have your retained earnings December 31, 2020 in the amount of 14 million. Okay, next we have 16-12. Right, 16-12. You have now your so far the same similar items, inventory, depreciation, accrued salaries. So what's important is you are knowledgeable with regards to this determination. So we have now your 16-13 questions 1 and 2. Net effect of the errors on retained earnings. And so we have problem 14. 14 with 3 requirements. So far the requirements are similar. Now you have your worksheet for 16-14 and 16-15. You have the worksheet at the bottom. That's 16-15, 16-16, and 17 and 18. Now likewise, you have your problem solutions for 16-19 and 20 for the theory part.